Good afternoon, everyone. Good morning or good evening, depending upon where you are in the world. And welcome to this webinar on Is Silver to Outshine in 2021. My name is Alessandro Soldari. I am the Executive Director of Goldavenue.com, an online platform to buy, sell, and store gold and other precious metals. And it's a real pleasure today to host this webinar. I hope the audience will learn valuable insight into the industry. And for this, we have here with two excellent guests that I will introduce. So Christian Gopal, Senior Analyst at the World Gold Council, the market development organization for the gold industry, and Michael Di Rienzo, the Executive Director of the Silver Institute, an international association whose membership comprised the major participants in the silver industry. And at the end of the webinar, Juan Carlos Artigas, the Global Head of Research at the World Gold Council, will join us to answer your questions. So feel free to ask your questions on the box on the right of the webinar, and at the end of the webinar, we will try to answer all the questions. So let's start with this webinar. I will start with the basic. So why someone has to need to consider having gold allocation in his portfolio? Christian, let's start with gold.
Thank you, Alessandro, and thank you for inviting me here today. It's a very good question, and one that we kind of address often when we speak to clients and institutional investors in the market. So the big question is why have an allocation to gold? Well, there are three key points that I would like to make. The first is returns. So many investors see that gold has no yield, it pays no dividend, it pays no coupon like a bond or a stock, and because of this they assume that it has no return, and that's not the case. If you look at the data from 1971 when gold became free floating, we actually see that gold returned on average about 11% in US dollar terms every year. So it's certainly something that can assist with the returns over the longer period. And that's actually in line with many commodities and stock indices that we've seen over a very similar period. The second point I'd like to make is diversification. Now, most investors agree that diversification is important when making their investments and risk management, but effective diversifiers are actually quite difficult to find. When market stress and uncertainty increases, we find that correlations tend to increase, which means that assets tend to move together. But gold stands apart from other assets in this respect, in that it tends to have a negative correlation, say, to equities, and that negative correlation actually becomes even stronger the further the equities tends to drop. So it tends to produce that portfolio protection exactly when investors need it. The final point is liquidity. Now, gold is an incredibly large and global market, and because of that, it's incredibly liquid. So on average, gold traded around 149 billion euros per day over 2020, and that's across spot and OTC derivatives and futures contracts. Now, if we add gold-backed ETFs to that, that's an additional source of liquidity. So what does that mean? Well, it means that the scale and the depth of the gold market means it can accommodate very large institutional buy and hold investors. And it also means that in times of crisis, that liquidity does not tend to dry up. So it means that that makes gold a far less volatile asset than many other diversifiers you may see out there. So those are some of the key reasons why we make the argument that gold can bring benefits to a portfolio, and how a strategic allocation can actually help improve risk-adjusted returns.
Oh, perfect, very interesting. And maybe we will touch on a word regarding the liquidity and which type of gold is better to buy. As you spoke about the ETF, about physical gold. So maybe we will have a few words later on that. And Michael, what about silver?
Sure. Well, first of all, again, thank you, Alessandro and Christian. It's a pleasure to be on this webinar with you. We appreciate the opportunity to talk about the white metal, it being silver. So silver, like gold, has been an investment and a treasured commodity for centuries. And if you just take last year, for example, and going on some of the 3 points that Krishan illustrated, diversification of a portfolio is certainly one reason why somebody would hold a hard asset such as silver. The silver market is not quite as liquid as the gold market, but good liquidity does exist in the market today. There are some that are arguing that that may not be the case, and we can talk about that a little bit later on with respect to the silver squeeze we saw earlier this year. But if you look at silver's performance in 2020, in a year that most commodity markets and most markets in general were severely impacted by the COVID-19 pandemic, it was the investment in silver that led to the price gains. We had a price gain last year of about 27%. And this year we're expecting even a greater price gain. When you look at the investment into ETPs, for example, it was a record year. Over 331 million ounces of silver were allocated into global ETPs. Physical demand was extraordinarily strong. You couldn't really get a coin or a bar at some points during the year. It was due to the strong demand, but more than so, it was due to the supply chains being interrupted and disrupted, and the manufacturing processes not able to keep up with the pace of demand. So we look at those factors. We feel very confident that 2021 is going to be a good year, but you also have to focus in to some of these extraordinary fiscal and monetary positions in a record in an era of a record debt accumulation through various governments across the world. So we feel that this year in particular, and even going forward beyond this year, it should be a healthy environment for silver investment.
Cool. And you spoke about ATP, that maybe not everyone know what is that exchange traded products. Maybe we'll talk about it a little bit later. But just to have an idea of what is the precious metals production and demand in silver. So how much silver is produced or from the mine production, how much silver come from the recycling, because we know that in precious metal, the recycling is quite a large percentage of the supply. And how is the demand structured?
So if you look at last year, for example, and we just recently put out last week our World Silver Survey 2021 that you can download at no cost from our website. Last year was the fourth consecutive year of a decline in mine supply. We expect that's going to turn around this year. And last year was really due to the fact that most of these, or many of these mines, and in very important silver mining countries like Peru and Mexico and others, were on COVID restrictions and could not operate. So we saw the fourth year of mine supply. We saw a slight increase in recycling of silver as the price got higher. People were turning some of their silver products for a price. And then you got a very small amount of net hedging supply. And then on the other supply side issue, it used to be a more important issue back in early 2000, 2003. Government sales of silver were almost minimal last year at that. And on the demand sector, we saw.
But just to have an idea in terms of amount in million of ounces of or in
so
tons,
supply,
what it looks like the supply of silver.
Total supply last year was a little over 1 billion ounces, so 1.056 ounces of silver was the total supply dynamic that came to the market.
So this is more or less 30,000 tons of silver, if I'm not wrong, more or less.
Approximately.
I did the calculations. I'll be more or less right. Okay, so 30,000 tons, so more or less 1 million of ounces of silver, and then the demand. How is structured demand?
That was a billion, 1.033 ounces. Okay, yeah. So 1.033 billion ounces. So just shy of the total supply.
Okay. And the demand, as you said before, so we have industrial demand, we have the jewelry, we have the physical investment. So I think this is the three main points someone has to know when you are seeing the supply and demand in precious metals. So what is the percentage of the demand that go in the industrial demand?
It's over 50%. Last year, I believe it was 55%. This year, we're calling for an even higher number. We think that
55 is a huge amount that is going
and
to
then
industrial.
on the investment side, and then when you add the investment side into the equation as well, we believe jewelry and silverware are also going to pick up this year, but that's coming off of a very low 2020.
Yeah, because I did some research, so we know that we have more than 50% that goes in the industrial demand. Then we have 25% in the jewelry and silverware, and then we have more or less 25% on the physical investment. And now I know also that Indian demand is huge compared to the worldwide demand. And now we are seeing, sadly, that COVID is a all-time high in India. So I think even the demand is not at its maximum grade in India regarding all the jewelry and silverware, right?
That's correct. And when it comes to jewelry and silverware, India is such an important country to the global demand sector for those two demand areas, jewelry and silverware. And if you took India out of the equation last year, silver would have had a fairly good year with respect to jewelry. We're hopeful that those markets and that country itself will get back on track and that they can slowly start putting, like some of the world has, this pandemic a little bit at ease.
Cool, very interesting. And what about gold, Christian? So we know that silver, there is a huge demand on the industrial demand, so more than 50%. What about gold in industrial demand, and what is compared to silver the production of gold each year?
So it's a very good question, and something we talk about quite a lot is gold's dual nature. And by that we mean we describe the market as being self-balancing, and that's due to the different elements of demand that we see. And it's really key to understanding gold's diversification benefits and its potential source as a its potential as a source of long-term returns. So the way that the market is structured is on the demand side, we tend to have jewelry and technology, which account for about 40% of annual demand. They're the kind of elements which are linked to economic expansion. They're pro-cyclical. So as incomes go up, we tend to see demand for gold jewelry and technology, which contain gold components, increase. So that's supportive of demand. Now, the other major category for gold demand is investment. So that counts for about 42% of demand, and particularly identifiable investment, kind of gold investment that we can measure. And this, while an element of it will be pro-cyclical, we will see demand for small bars and coins from retail investors. When we see economic expansion, this tends to be mostly responsive to risk and uncertainty. So as we saw last year, and I'm sure we saw with silver, is that as the COVID pandemic took hold, as we see greater levels of risk and uncertainty in the market, safe haven demand will come in from the investment side. We will see investment into products from the institutional side. So last year we saw record levels of inflows into gold-backed ETFs globally, I think in the region of 800 to 900 tons. And so it really shows that there are different drivers to gold demand on any particular year. Some are pro-cyclical, some are counter-cyclical, and because of that, it brings an added level of stability to gold demand and the gold market more widely. Now, on the supply side, we see between 4,500 to 5,000 tons of gold brought to the market every year. Now, about 75% of that tends to be from mine production, so that's gold freshly dug out of the ground, where the remaining 25% being from recycled sources. So recycling is a huge component of the supply side for gold, which helps bring a kind of a nice balance to the supply side when we see that demand is far higher than we might have expected, or the price increases, that will help draw out some of that recycled stock and help kind of maintain that balance within the market between the demand and supply sectors.
And do you think it's mine production stable or not? Because at the end of the day, the mine production is the inflation on the gold supply, you know? So is the mine production decreasing, increasing in the last, I don't know, 5 years?
So we've tend to see over the last 5 to 10 years that gold mining has been increasing between 1 to 2% every year. Last year was a bit of an outlier for the reasons that Mike kind of explained, that COVID obviously had a big impact in terms of the demand and the supply side. We saw similarly kind of impacts on mine production with temporary closures of mines in certain jurisdictions, which impacted the overall annual figure or annual level of mine production that we saw last year. But gold mining has been remarkably stable. And if you think that it's mined on every continent bar Antarctica, that kind of geographic dispersion again brings a level of stability where you see impacts in one jurisdiction, it won't severely impact the overall level of global mine supply that we see.
Cool, very interesting.
Sandro,
yeah.
Can I say something here about the silver
Yeah,
side real quick?
Sure.
It's important to note on silver that only about 27% comes from a primary silver mine each year. So newly mined silver activity is coming from a very small output, less than 30% of a primary silver mine. And it really does rely on lead, copper, gold, and zinc mining activities to make up the difference. And that's a point I forgot to put in.
Yeah, it's very interesting. I was not aware that silver is coming from other mines, so not silver primary from silver mine, but other mines. That is a second material that they are mining. So there is a okay, very interesting. And again, maybe Christian, regarding the gold AFP that we saw last April, so AFP exchange for physical. So it's kind of a future where people can buy, or a contract that you're buying gold in a second moment. I am more or less right? I don't hear.
Sorry, the exchange for physical was, for all intents and purposes, representing the difference between delivering gold in London versus New York. Now, Mike earlier mentioned that last year, because of COVID, we experienced disruption to the global gold supply, as we did in silver. And what that meant was actually moving gold physically from location to location, so London to New York, was incredibly difficult. We wrote a paper on that last year, which kind of delved into the details, where we saw reduced number of commercial flights, which often is used to transport gold, disruption at refineries or mints, which again kind of caused problems and disruptions in the entire supply chain, which kind of led to that growing discrepancy in the exchange for physical, which we did indeed see blow out kind of in March, April last year, but since has come down to much more normal levels. And I think what that shows is that the global gold supply, at least, is incredibly resilient. I think the disruption did last for a couple of months, but certainly things got back on track, and there was no severe disruption to the wider gold market, which you might expect given the level of disruption that the pandemic caused when it first kind of took hold.
So to explain to the audience, this discrepancy is the premium on the physical exchange of products compared to the spot price of the metal, right?
So it's a comparison between the spot price in London versus the futures price we get in New York. So the difference, because of that, the difficulty of moving physical gold from one location to the other, caused that difference, which ordinarily should be quite small, because otherwise it would create an arbitrage, kind of blew out, representing those difficulties in the supply and movement of gold.
And do you think this dynamic will return or not in the near future? The fact that we have a huge premium regarding the physical product?
Well, I think it's difficult to say. I think looking at more recent data, that doesn't appear to be the case, and I certainly don't think that where we are in the pandemic right now is anywhere near where we were when this first took hold last year. So I don't foresee that happening. I think what we're seeing in the moment with potential increased premiums is potentially slight kind of bottlenecks in supply, but at a very, very small level. Ordinarily, I think or kind of overall, I think we're seeing that the gold market is functioning very, very smoothly.
Okay, cool, very interesting. And Michael, maybe we get to the question everyone is asking right now regarding the silver squeeze. What is happening? What happens in the February when, if I'm not wrong, in 3 days we had a demand of 4,000 tons of ATP, so these famous exchange traded products. Maybe you can tell a little bit more what happens, what exactly is an ATP, or just to let the audience understand what we were talking about.
So ETPs, really came onto the market, exchange traded products, some call them exchange traded funds, for the silver side in 2006 when Barclays launched the iShares product, which has since been bought by BlackRock. And a whole host of others have arisen based in various regions throughout the world and suited to particular types of investors. And I mentioned earlier that over 331 million ounces of silver went to ETPs in 2020. Huge. And this year, we're starting off very, very well. These are both institutional, but they're also retail investors. Mm-hmm. And we think this we're going to get about half that, about 150 million ounces of silver into ETPs. And historically, that is a rather high number for overall demand for this investment product. They're going very, very strong, as I mentioned. Earlier in the year, we all are aware of what is now called the silver squeeze, and on social media platforms, primarily on Reddit, with the hashtag silver squeeze and hashtag Wall Street Silver. I can tell you, quite frankly, from the Institute's perspective, we saw our Twitter followers increase almost 100%.
Wow, crazy.
December of last year to where we are today. And the thing that's unique about that, but not terribly unique, the thing that's sort of interesting about that is these folks are passionate about silver, and they're passionate about all aspects of the metal. And they feel that in some respects that the metal is being shortchanged, that there's manipulation of the market. And we believe that regulators across the world have done a fairly good job in catching the bad actors, and we know there have been bad actors in recent history, and they've been caught, and banks are paying fines, individuals are paying fines, and some people may even see jail time as a result. But this Reddit-based squeeze, it fueled investors buying across all arenas, both retail and institutional. And it wasn't just ETPs, it was demand for physical as well. So it's had a lasting effect on silver investment if you look at the price performance of the metal this year. While they have retraced somewhat from the $30 high, they're still very, very strong when you compare them over a 10-year time frame as we exited the first quarter of the year. We think that investor appetite for the metal has remained healthy and is more or less consistent with early February, even though the numbers are not as high. But like I mentioned, these are passionate investors. They come from all food groups, from all over the world, and they're here to stay.
But if I'm right, an ATP don't need to be 100% fully back with a collateral, right?
I think in some cases that's correct. But if you take the iShares product, for example, it is backed by an ounce of silver, and you can buy the ETP in terms of an ounce of the silver. And there are other ETPs that will be more fractional. I know that the World Gold Council has a fractional based product which is priced perfect for an investor. The ETPs for silver are typically, but I don't want to say unilaterally, backed by 1 ounce of silver.
Okay, and so when you have to suggest to someone you know if he has to buy, I don't know, physical product, ATP or other derivatives, what do you suggest him?
So what we like to say is this, it depends on the appetite of the investor. So we deal with and talk to on a daily basis people who swear by physical silver. So they want to have the tangible asset in their hands. They want silver bars, exactly. They want silver coins. They want to have those in their possession. In many cases, depending on the quantity of silver that they purchase or have,
Yeah, yeah.
they have to put that in the hands of a third-party custodian. And when you're dealing with that, you're dealing with a small transactional fee and insurance cost and other aspects of that, depending on obviously the size and quantity of the silver. With an ETP, it trades almost and it's like a mutual fund. You can trade in and out of your brokerage accounts and purchase the silver. You can sell the silver as easily as making a stock transaction. One thing we have found on the silver side, and one thing that we talk about when it comes to ETPs, is that silver investors tend to be sticky. They hold on to that product for a longer period of time. Whereas on the physical side, you can see trading in and out of those markets rather frequently.
Okay, cool, very interesting. And Christian, regarding the outlook for gold in 2021, what is the view of the World Gold Council for the rest of the year?
So it's another great question. So I would point to the overall environment that we've seen. So much of the news this year has been on rising treasury yields or sovereign yields. We've seen it in the US, we've seen it in Europe. But I think it's important to emphasize that interest rates still remain structurally low. We are still very much in a low rate environment. And that has impacted investors. They have been forced to rethink traditional asset allocations and strategies. And there's just been a general hunt for yield, with bonds being able to provide less, with dividends having been cut last year and under pressure still. And so that has boosted gold's the interest in gold because of the opportunity cost. As interest rates stay lower, the opportunity cost of holding gold becomes a lot smaller. We're also seeing high market valuations for equities, for example. We're seeing headlines of continuous high valuations, of reaching record all-time highs. So I think as well, because of the levels where we are, there's always that potential that we may see equity market corrections, and a kind of prudent risk management would be to kind of make sure your portfolio is kind of protected against that potential risk. Finally, I would also say that, look, we've seen, as a result of the coronavirus pandemic, tremendous amounts of fiscal and monetary stimulus. We've seen ballooning budget deficits from governments across the world. We've seen growing levels of the money supply, and all of that combined with the low interest rates kind of creates a kind of a much greater level of inflationary pressures. And again, historically, we've seen that when there is equity market pullbacks, when there is high inflation, gold historically performs incredibly well. So I think the outlook for gold, the environment, is still relatively strong. It's conducive to having an allocation to gold for prudent risk management. And we would say that, you don't look to start planning for your risk management during a crisis. It should be something that you do long in advance. So I think the outlook for gold for the rest of 2020 is still very supportive. And I would finally add also is the economic expansion point I made earlier. That too is supportive for gold. That, should we see a continued economic recovery from the pandemic from here on in, we should hopefully see a response from consumer demand, so jewelry, technology, and some elements of bar and coin, which should also be boosted by that as well.
Okay, cool, very interesting. And I imagine, Michael, since we always say that silver is gold on steroid, you are more or less aligned with the outlook of gold, no?
We are indeed, and since silver, is both a investment and an industrial metal, we think that as these vaccinations start to spread and people are taking them across the global economies, we think that industry is going to pick up. I noted that in a speech I gave last Friday that the International Monetary Fund is calling for a 6% increase in global GDP for 2021. And we think that bodes well for silver, especially on the industrial side. We think that the industrial side is going to grow by about 8% in 2021. We think that that will be led by a demand in electronics and electric products. So we think that's a plus for silver. We also think that photovoltaic demand, silver's use in solar clean energies, is going to continue to grow to about 105 million ounces this year. And we think that silver's role in automobiles is going to grow. You know, as the world looks at a way to somehow reduce its reliance on fossil fuels, we see more and more hybrid and electric vehicles being made available to consumers. And as a result of not only that demand for those particular vehicles, but also government policies mandating that certain fleets, for example, in the United States, President Biden signed an executive order stating that from some period and going forward that U.S. government vehicles have to be either hybrid or all electric by a certain time frame. In California, we saw legislation mandating that new residential homes be equipped with solar power energy systems. So we think this is a win-win for silver down the road as its use in photovoltaics, as well as its use in automotive vehicles continues to grow, because silver is used in all of these vehicles. It's the electrical contact that makes these vehicles go. And as you get more complexity into the vehicles, not only with BEV, battery operated electric vehicles, but also down the road, autonomous vehicles, we think that silver's growth by 2025 or annual use will be about 85 million ounces. So just shy of 90 million ounces in just a short 4-year period of time.
Incredible. But I have hundreds of questions. Like, we can stay here 2 hours speaking together, but the goal is maybe also to involve the audience. I see that there is a lot of question here, so I will skip a little bit my question. Maybe if we have still 5 minutes later, I will re-jump on a few, even a personal question I have on silver and gold. I used to sell physical product, but I still have a question that I would like to ask to expert like you. But let's switch to the audience. So let's start with the questions, and if someone of the 75 participants has any other question, don't hesitate to write. So the first one by Hamad is it possible for gold to have an increase like the usual years before COVID for the future prospect?
So I think COVID was a kind of once in a generational event. It certainly was unprecedented to many levels. But what I would say is, while we did see about a 25% increase in the gold price during 2020, gold was actually rallying in 2019 as well. So I'd go back to the point that I made earlier, that actually, you know, over the long run, we see that gold does produce a return which can benefit investors. Now, what that might mean for gold going forward, obviously we can't say, but certainly I think, as I mentioned in my outlook response, was that I think there are levels of support or areas of support we can see for investment demand and consumer demand. But in terms of where the kind of the price performance might go, it's very difficult to say, and not something we generally comment on.
Okay, cool, thank you. And now we have a question from Romain. It's more on silver probably. Hello, do you know why every goods are up? Sugar, wheat, copper, probably woods. Everyone saw this meme on woods price that is going up and up, but silver are not reflecting the demand. So this is the first question. Then he had a second question in the first question regarding silver. So do you think that the shortage of electronic components could be due to the shortage of silver metals?
Well, that's a great question, and I can speak to the second part of that question, and it goes again back to the supply issue and the manufacturing issues. Look at the globe, the world was severely disrupted in 2020, and it affected almost every aspect of the silver market, and not only on the investment side, but especially on the industrial side, where there were shortages. It was difficult to ship, it was difficult to trade. We have a great chapter in our latest World Silver Survey on bullion flows, and the bullion flows were severely impacted in 2020. They're improving today, and we think by the end of the year they could be back at a 2019 level. So we think that the industrial end users who rely on certain quality grades of silver, as the year improves, will be able to have greater access to the silver for their particular application.
Okay, cool. And now we just receive by email a question. Probably someone was not able to write the question on the web. Does the paper market, the paper gold, I imagine, affect the price of physical gold?
So it's a one gold price. Well, what we see is in the short term, investment markets and investment macroeconomic variables will tend to have an influence on the performance of gold. But over the longer term, what we tend to see is actually it's the impact in the kind of the interaction between demand and supply, as well as the investment side of the market, which kind of determines gold's overall performance. Now, what we've got on our website is an online tool which is called Quorum, which we built to help investors understand the various macroeconomic variables and scenarios which can influence demand and supply, and in turn how that impact on demand supply will impact or influence the performance of gold. And it's something that users can interact with. It's kind of based on our model, but users can input their different assumptions and expectations, and it'll help generate a kind of implied gold return. So depending on your views of the world, you could see how that dynamic plays through from macroeconomic variables through the demand and supply, and then into gold's performance.
Oh, cool. But after the webinar, we will send an email with all the links to all the participants, because I think both you have a very, very good website with a lot of useful content for someone who is interested in precious metal. Now we have a question regarding the silver. Probably is always more or less the same question, but why bank always manipulate the price of silver, putting the price down? So I think there is a lot of people that believe that there is a lot of manipulation on the price of silver, and that the price of silver should be higher than the one is at the moment.
Well, look, we hear from folks who are passionate about that belief on a daily basis. We get emails and phone calls and so forth. And one of the things that we've done over the course of the last 6, 7, 8, 10 years is we've made ourselves and the market players available to regulatory bodies, and in the United States, the CFTC. So we do chat with them. And if we see anything that's out of the ordinary, we will contact them. They ask us how the markets are flowing, basically on a quarterly basis. But quite frankly, I think that the government regulators need to pay more serious attention to the concerns of many investors in the market who are making this case. We sort of remain agnostic on this as a marketer for the metal of silver, but we hear those concerns daily. I express those concerns to the CFTC here in the United States, and we will continue to do so. What we want to ensure is that every voice is heard and these allegations are addressed in a formal governmental process.
Okay, cool. And now we have a question that is more a financial question, so I don't think that neither Christian or Michael can answer. Shall we buy the dip after the crisis occurs, or buy now regardless? So probably no one can answer this question, because if we have a crystal ball, we will be all rich. But I think that precious metal, as said before by Michael and Christian, must be a part of a well-diversified portfolio. So it's not when to buy silver and gold, but if yes or not to have precious metal in a well-diversified portfolio. No.
Mm-hmm.
So yeah, we would. Oh, sorry, Michael, after you.
No, go ahead, Christian.
I was just thank you. I was just going to make the point that we advocate a strategic allocation to gold. So almost exactly as you said, we advocate holding gold as part of a portfolio. Now, what allocation that might be depends on the particular investor, but certainly we feel that it should be a strategic holding, because for the benefits that I've already mentioned, there is a kind of research analysis that we've provided on our website Gold Hub that shows that there is a kind of a meaningful benefit to holding a gold as part of a well-diversified portfolio.
Yeah, and that's good, Christian. I've been to your site. That is a very informative piece of work under the Gold Hub banner through the WGC. We have a section on investment on the Silver Institute's website at silverinstitute.org, and we outline the various investment opportunities for somebody. We personally do not give out investment advice, but we strongly feel, like Christian and his colleagues at the World Gold Council, that some part of your portfolio should be allocated to silver. And we make that argument on our website, and we also provide opportunities to contact certain dealers and certain investment providers directly from our website in order to take that first step.
Mm-hmm, mm-hmm. And probably we will take the last question, because I have my colleague here that say you have to end the webinar. We're running out of time, but we have a lot of questions. Very happy that the audience appreciate the format. And again, I say to the audience that they can check both websites, so the World Gold Council and the Silver Institute platform, that is full of valuable content. So just pick one last question. How do short position from big players compare to the yearly production of silver? How the short position from big players compare the yearly production of silver?
I'm not sure I understand the question. Can you rephrase it?
How do short position from big players? So I think that the person means that how the short position from big players, like big banks probably shorting silver.
Yeah. You know, I've already answered that question with respect to regulation and regulators. It's something that, like, again, we hear from every day. If you go to our Twitter page, I mean, we're lit up on these questions. These are legitimate concerns, okay, that need to be addressed across all global markets. I mean, regulators really need to start addressing these questions, which are occurring more and more frequently. And the accusations about certain banks shorting their position, banks holding more silver than they actually report, banks crushing the silver price when they go to work in the morning, all the advantages that were made in Asia and Europe, and then certain banks check in the morning and on the East Coast and drive the price down. I can't answer those questions, but regulators certainly can. So I would encourage anybody who has these concerns to contact the CFTC in the United States and other regulators overseas, because quite frankly, that's their job to investigate. Now, from the CFTC standpoint, these allegations have been going on for quite some time. And they've written at least 2 letters that I'm aware of that addresses the points that have been made. But quite frankly, the issue still exists and investors are still concerned. So on behalf of them, we encourage the regulators to start really answering these questions immediately.
Cool, perfect. Again, we still have a lot of questions, but the time is running fast. We're fast running out of time. So again, thank you very much, Michael and Christian, for your valuable content. I hope the audience were able to learn a lot of insight into the industry. And again, we will send to all the attendees the details of some PDF to analyze more of some research you do from your side, guys. So thank you again for taking the time to participate, and I hope we can talk again soon regarding the outlook, maybe in 2022.
Thank you very much.
Thank you, Alessandro. Thank you, Mike.
Thank you. Bye. Bye.
Thank you. Thank you,
Bye-bye, everyone.
Alessandro.
Bye, everyone,
Bye.
and thank you all the attendees to participate to this webinar. Bye.
Thank you.